In a series of tweets, U.S. President Donald Trump sought to reaffirm his power over U.S.-China trade, declaring himself a tariff man. Trump said he wouldn't hesitate to impose tariffs on China if negotiations fail on a final deal. Trump said, and I quote, "We are either going to have a real deal with China or no deal at all, at which point we will be charging major tariffs against Chinese products being shipped into the U.S. Ultimately, I believe we will be making a deal either now or into the future," unquote. The president showed optimism about reaching a fair deal, but stressed that he is a tariff man if talks fail. Trump said, and I quote, "I'm a tariff man. When people or countries come in to the raid, the great wealth of a nation, I want them to pay for the privilege of doing so. It will always be the best way to max out our economic power. We are right now taking in $1 billion in tariffs, much and to make America rich again," unquote. During last week's G20 summit, Trump and Xi pledged not to impose new tariffs on each other's country for 90 days during negotiations. Trump and Xi's announcement has already had a positive impact on global markets in the short term. Stocks slumped on Wall Street Tuesday as traders worried that the U.S. and China made less progress than originally thought on diffusing their dispute over trade. Bond prices surged, sending yields sharply lower as investors turn to lower risk assets.
So basically, over the last week or two, we had two pieces of good news for the market. We had what appeared to be some good progress on China trade dispute. That is now in question. Another thing that happened last week was we got a signal from the Federal Reserve that interest rates might not be increasing as fast. Now there's a little bit more doubt about that too. And as if we didn't have enough to worry about, there's also a pretty bad signal on the housing market today. We had some really poor forecasts from a major home builder about that. Also, importantly, the bond market is telling us that they think the economy may slow down. That means that interest rates are coming down in the bond market. That happens when investors want to buy bonds and they think that the economy may not be as strong as we thought. That's not good for banks, especially because that means they won't make as much money from lending.